The number on your screen doesn't match the life you're living, and that's exactly the point. $10,412,000 in trailing revenue. One name on the payroll, yours. No office, no team Slack pinging at 11 p.m., no health insurance to sort out for anyone but you. You built a business that crossed 8 figures without ever hiring a single employee, and somehow that fact still catches in your throat every time you say it out loud, because for 20 years everyone told you it couldn't be done this way. You grew up on the old math. Revenue goes up, headcount goes up. It's practically scripture in every business book stacked on your shelf. Want to hit 1 million? Hire a salesperson? Want to hit 10 million? Hire 50 people, rent an office with a ping pong table nobody uses, and pray the org chart holds together. That's the story you were sold, the one where growth and payroll move in lockstep like they're chained at the ankle. You believed it long enough to almost build your first company that way, before you ever ran the numbers on what 50 salaries actually does to a bank account at 2 a.m. Then you meet someone like Priya Okafor, not the version cosplaying poverty on a rented farm, a different Priya. This one runs a supplement brand out of a 2-bedroom apartment in Austin, doing $9.6 million a year, and when you ask her how many people work for her, she laughs and says, define work. No employees, no contractors on payroll. Just software doing the job 40 people used to do, and a handful of freelancers she pays per project through a marketplace, never a W-2 in sight. You sit across from her at a coffee shop, watching her approve a meta ad campaign, answer a customer service ticket routed through an AI layer, and check a fulfillment dashboard, all in the span of 6 minutes, and you realize you're watching the org chart get deleted in real time. This is the part that used to not compute. Scaling meant bodies. More orders meant more hands to pack them. More emails meant more people to answer them. More customers meant a customer service department, with a manager and a manager's manager. That was true in 2015. It was mostly true in 2019. But somewhere between 2023 and now, the entire equation flipped, and almost nobody updated their mental model to match it. Here's what actually happened. AI stopped being a toy and started being a coworker that never sleeps, never asks for a raise, and never quits 2 weeks after training. Automation platforms that used to require a developer on staff now get built by someone with zero code experience in an afternoon. Marketplaces sprang up where you can rent a logistics team, a customer support team, an entire ad buying department, by the hour, by the task, by the outcome, without ever putting a single person on your books. The tools didn't just get better. They got cheap enough and simple enough that one person with a laptop and a checking account can now operate at a scale that used to require a building full of desks. This is leverage without labor, and once you see it, you can't unsee it. Leverage used to mean people. You hired someone so their hours multiplied your hours. 10 employees meant 10 times the output, in theory, minus the meetings, minus the management, minus the slow bleed of coordination costs nobody puts in the pitch deck. Leverage without labor means the multiplication still happens, but the machine doing it isn't a person who needs a desk and a dental plan. It's code. It's an AI model answering 3,000 customer emails a night in your exact brand voice. It's a fulfillment center you've never physically visited handling every order that comes in. It's an ad algorithm optimizing spend across 100,000 impressions while you're asleep. No manager required to babysit it. You think about a guy named Trent Kessler, who you read about the same week you meet Priya? Trent runs a digital course business teaching people how to refinish furniture, of all things. $11.4 million last year. He has never had a payroll. He edits nothing himself anymore. An AI video tool trims and capuchones every lesson. His emails are handled by a support system trained on 18 months of his own past responses. His ad account runs on autopilot rules he set up once and adjusts maybe twice a month. When people ask how many people work for him, he says the same thing every time. Just the algorithms and me. It sounds like a joke until you look at his bank statements. That's the story you're about to walk through. Not the highlight reel version, not the screenshot of a striped dashboard that conveniently leaves out every cost that made it possible. The real one. How the financial engine actually works when there's no team absorbing the labor, where the money really goes instead of payroll, what gets automated versus what still needs a human decision, and where this whole model quietly breaks if you're not paying attention. Because building a company to 10 million with 0 employees isn't magic, and it isn't luck. It's a completely different set of math, running on a completely different set of assumptions than the ones you were taught to trust. And once you see the numbers behind it, you'll understand exactly why the old rule, more revenue always means more headcount, was never actually a law. It was just the only tool available at the time. So let's actually open the hood on this thing, because no employee sounds like a lifestyle choice until you see what it does to a P&L. Pull up any traditional business doing $10 million in revenue, and you'll usually find something like this. 40% to 60% of that revenue evaporates into payroll before it ever touches a profit line. Salaries, payroll tax, benefits, the office lease that exists because people need somewhere to sit, the software licenses purchased per seat instead of per business. A $10 million agency with 30 employees might be lucky to keep $1.2 million of that as actual profit. Everything else went to keep the machine of people running. Now look at Trent's numbers, the furniture guy. $11.4 million in revenue last year, and his cost structure looks almost insulting by comparison. Hosting and software, maybe $180,000 a year. Ad spend, $2.1 million, but that's buying customers, not people. Payment processing fees, roughly $330,000. Contractors paid per project through marketplaces, another $400,000, and none of them ever see a W-2 or a health plan or an HR department mediating a dispute. Added up, and his total cost of running the business sits around $3.4 million. That leaves him north of $8 million in profit on $11.4 million in revenue. Not revenue, profit. That's a 70% margin in a business model that would have required 40 salaried employees a decade ago just to keep the lights on. That gap, the space between a 12% margin business and a 70% margin business, isn't magic. It's a direct function of what you're actually selling. This only works because of the model underneath it, and the model has to be high margin by design, not by accident. Info products, SaaS, licensing, content with an audience attached. These are businesses where the 1,000th customer costs you almost nothing extra to serve compared to the first one. Trent's course doesn't need him to personally show up and refinish a dresser for every student who buys it. He filmed it once. The video sells itself 9,000 more times without him lifting a finger, without hiring a single instructor to teach it live. Priya supplement brand still has physical cost of goods, sure, but even there, the fulfillment and customer service layers that used to require 12 people now run through software she pays a flat monthly fee for, whether she processes 300 orders or 30,000. Compare that to a business that has to trade hours for dollars. A consulting firm, a home services company, anything where revenue growth is mathematically tied to adding another body to handle the next client. In those models, hitting $10 million almost forces you into 50, 60, 80 employees because the thing you're selling doesn't scale without more hands physically doing it. The solo operator businesses that actually reach 8 figures all share this one trait. What they sell can be duplicated infinitely at almost zero marginal cost. That's not a lucky break. That's the entire precondition for this whole model working at all. Here's the part that surprises people once they actually sit with it. Pricing matters more than volume when you're solo, and it's not close. A traditional employee-based business often wins by grinding out volume because it has the staff to handle volume. You don't have that luxury, and honestly, you don't need it. Trent doesn't need 300,000 customers paying $37. He needs roughly 11,000 customers paying $997 for his flagship course. And suddenly you understand why he spends more time thinking about his sales page and his positioning than he does chasing reach. One customer paying $997 does the same work in his bank account as 27 customers paying $37, except it takes him a fraction of the operational load to serve that one $997 buyer because the delivery is the same automated system either way. Positioning yourself as the premium, obvious choice in a narrow category beats being the cheapest option in a crowded one every single time, when there's no team to absorb the extra volume that low pricing demands. Then there's what you do with the money once it's actually yours to keep, and this is where the real compounding starts. In a payroll-heavy business, profit gets swallowed by raises, by headcount growth that has to match revenue growth, by the fact that every dollar of new revenue seems to require 90 cents of new cost just to service it. In a solo operation, reinvestment goes somewhere completely different. It goes into better tools, not more people. A $400 a month upgrade to an AI customer service system that used to require 2 full-time hires at $3,800 a month each. A $12,000 investment in a custom automation build that replaces what would have been an ops manager's entire annual salary. You're not scaling by adding humans who need training and management and Tuesdays off. You're scaling by upgrading software that gets better every single quarter without you doing anything at all. And this is where the compounding actually shows up in the number on the screen. Year 1, you're doing $800,000 in revenue at maybe 55% margin because you're still building the systems, still paying for tools you haven't fully dialed in. That's $440,000 kept. You reinvest a chunk of it into better automation, sharper positioning, a slightly higher price point. Year 2, revenue jumps to $2.4 million, but margin climbs to 65% because the systems you built are now doing more of the work for free. That's $1.56 million kept. Year 3, $5.1 million in revenue at 70% margin, systems fully humming, positioning locked in as the premium option in your space. That's $3.57 million kept. Year 4, you cross $9.8 million, margin holds at 70%, and you're sitting on $6.86 million in profit. All of it compounding back into better tools, not more headcount, not more overhead, not more Tuesdays spent managing someone else's calendar. That's the engine. Not one big break. Margin stacking on margin quarter after quarter because there was never a payroll eating the difference in the first place. So here's the question that actually matters once you've seen the margins. If you're not hiring, who's doing the work? Because someone is. The furniture on Trent's screen doesn't refinish itself, the emails don't answer themselves, and the 9,000 people who bought his course still expect the video to load. The answer isn't no labor. It's labor you don't own. Start with the distinction almost nobody explains correctly. An employee costs you roughly 1.3 to 1.4 times their salary once you stack in payroll tax, workers' comp, benefits, unemployment insurance, and the software seat you have to buy them just so they can do the job. A $60,000 employee is really an $80,000 line item before they've generated a single dollar. A contractor costs you exactly what you agreed to pay them. No withholding, no benefits, no legal exposure if you need to end the relationship next month instead of next year. Trent pays a freelance video editor $1,200 a project through a marketplace. If that editor missed 3 deadlines in a row, Trent replaces him by Friday. No HR conversation, no severance, no awkward performance review. That flexibility is the entire point. You're not avoiding labor. You're avoiding the fixed, permanent, legally entangled version of labor. Then there's the layer that didn't exist 5 years ago and now quietly does the job of an entire department. AI tools have absorbed roles that used to require a full-time hire sitting at a desk from 9 to 5. A customer support inbox that used to need 2 people answering tickets now runs through an AI system trained on your FAQs, your refund policy, your tone of voice, handling 80% of tickets without a human touching them, and flagging only the weird edge cases for you to glance at once a day. Copywriting that used to require a hired writer on retainer now gets a first draft from a language model in 9 seconds, and you spend 20 minutes editing it into your voice instead of 40 hours writing it from scratch. Priya runs her supplement brand's product descriptions, her email sequences, even her customer win-back campaigns through tools that cost her $200 a month combined. Tools doing work that would have needed a marketing coordinator earning $52,000 a year plus benefits. Automation software handles the parts of the business that used to require a body physically clicking buttons. Order confirmations, shipping updates, abandoned cart emails, subscription renewals, refund processing, all of it running on triggers you set up once and never touch again unless something breaks. This is the part people underestimate the most, because it doesn't feel like replacing an employee. It feels like paying for software. But that software is quietly doing the job 3 people use to split shifts to cover. A $79 a month tool handling customer service tagging and routing is standing in for an ops coordinator. A $150 a month inventory sync tool is standing in for someone whose entire job used to be checking spreadsheets and calling suppliers. You're not paying salaries, you're paying rent on labor, and the rent never asks for a raise. For the pieces that genuinely need a human hand, that's where done-for-you services and agencies come in. And this is the part that looks the most like having employees without any of the actual liability. Trent doesn't have an in-house video team. He pays an agency $4,000 a month for editing, thumbnail design, and upload scheduling, and if he needs to scale that up during a launch or scale it down during a slow month, he sends 1 email. No layoffs, no severance, no morale hit to manage. A bookkeeping firm handles his monthly reconciliation for $600 a month instead of a full-time controller earning $70,000 plus benefits. A fulfillment center packs and ships every order without him ever touching a box, charging him per unit instead of per hour, per benefit package, per sick day. You get access to skilled labor exactly when you need it, at exactly the volume you need it, and you never carry the cost during the weeks you don't. But none of this works. Not the AI, not the automation, not the agencies, if you skip the step that has to come first. You need the system written down before you hand it to anyone or anything else to execute. This is the unglamorous part nobody puts in the highlight reel. Before Trent's editing agency could touch a single video, he had to write out exactly how he wanted footage organized, exactly what his intro and outro looked like, exactly how long a video should run before attention drops off. That document is 22 pages long. It took him 3 weekends to build. But once it existed, he could hand it to any editor, any agency, any future AI tool, and get consistent output without standing over anyone's shoulder. The system is what you're actually scaling. The tools are just executing it faster than a human ever could. And here's the trade-off you have to sit with honestly, because it's real and it doesn't disappear just because the margins look good. You give up a layer of control you'd have with an in-house team sitting 6 feet away from you. You can't walk over to someone's desk and fix a mistake in real time. You're managing relationships through Slack messages and shared docs instead of hallway conversations, and when 3 different vendors all miss a handoff in the same week, there's no single person to sit down and hold accountable the way you could with a direct report. Complexity shifts from managing people to managing systems, contracts, and integrations that all have to talk to each other correctly. What you get in exchange is a cost structure that flexes with your revenue instead of sitting there fixed no matter what month it is. No employee ever asked to be paid less during a slow quarter. Your software subscriptions and contractor invoices do exactly that automatically every single time. So the margins work. The systems run, the agency emails get answered within the hour, and nobody's asking you for a raise. It feels, for a while, like you found the cheat code. And then you get the flu in October, the kind that puts you flat for 6 days, and you realize nobody is opening your laptop but you. That's the part the highlight reel skips. You are the single point of failure in a business built entirely around removing single points of failure everywhere else. Trent's editing agency can miss a deadline, and he swaps them by Friday. But if Trent himself disappears for a week, no course sells, no email goes out, no decision gets made about the refund request sitting in the inbox his AI flagged as needs human judgment. You built a business with 0 employees, which also means a business with 0 backup. Priya's supplement brand runs on $200 worth of software and a handful of contractors, but Priya is the one who has to notice when the automation breaks, when the AI starts hallucinating product claims in an email that could get her sued, when a contractor goes mid-launch. You didn't remove risk, you concentrated it into one nervous system, yours. Burnout isn't a mood in this model. It's a business continuity problem with your name on the invoice. Then there's the part almost nobody tells you until an accountant says it to your face with a straight expression that scares you more than yelling would. Solo founders miss things employees and their employers are legally forced to handle for them. When you're on payroll somewhere, someone else is withholding your taxes, matching your social security contribution, filing your unemployment insurance, making sure workers' comp exists in case you fall off a ladder. When you're a one-person LLC pulling in $840,000 a year with no employees, none of that happens automatically. You owe self-employment tax on top of income tax, roughly 15.3% before you even get to federal brackets, and if you didn't set aside quarterly estimated payments, the IRS charges you a penalty for underpayment even if you pay the full amount by April. You find this out the way most people do, late. A guy running a one-person consulting business grossing $310,000 a year got hit with an $11,000 penalty notice 18 months in, not because he didn't pay his taxes, but because he paid them all at once instead of quarterly, and the IRS doesn't care that the money eventually arrived. Add in sales tax nexus rules that change state by state, contractor misclassification risk if your contractor starts looking like a de facto employee under labor law, and liability exposure sitting on your personal assets if your LLC paperwork isn't actually maintained correctly. Nobody hands you an employee handbook for this. You're supposed to already know. Then there's the trap that looks like success while it's actually quietly building a cliff edge. One client, one platform, one revenue stream carrying 70% or more of your income. It feels stable because the number is big. It isn't stable. It's fragile wearing a stable costume. Trent's course business runs almost entirely through one email list and one ad platform. If that platform changes its algorithm, or that list gets flagged for spam, or Trent's biggest affiliate partner walks, the $10 million business doesn't shrink 10%. It can drop 40% in a single quarter because there was never a second engine running underneath it. And underpricing makes this worse, not better. A one-person shop that charges $3,000 for work worth $9,000 because they're scared of losing the one client. Keeping the lights on isn't being humble. They're building a business that can't survive losing that client because there's no margin cushion left to absorb the shock when it happens. Concentration risk doesn't announce itself. It just sits there quietly until the one thing holding it up moves. And here's the question almost nobody asks until they're forced to. What happens when you want out? A business with 50 employees and documented systems has something to sell, an operations manual, a management layer, a company that runs without the founder standing in the room. A one-person business where you are the product, the fulfillment, the customer service, and the brand voice is often worth almost nothing to a buyer the moment you stop showing up. You can't hand someone the keys to your own face, your own inbox, your own judgment calls made 300 times a year. Some solo founders spend 2 full years before an exit just building documentation and training a skeleton team specifically so the business becomes sellable at all, which quietly undercuts the entire no employees thesis the moment you actually want liquidity instead of just income. None of this means the model is broken. It means leverage without employees is real, but it isn't free. It runs on financial literacy replacing the safety net a team used to provide, quarterly tax discipline replacing a payroll department, and deliberate diversification replacing the illusion of stability that one big number gives you. And here's the one nobody warns you about until it's already cost them. The average solo founder discovers their quarterly estimated tax obligation is wrong somewhere between month 14 and month 18 of running a 6-figure one-person business, usually via a penalty notice between $4,000 and $14,000 depending on revenue, money that a single conversation with the right structure would have avoided entirely. That mistake is sitting in the description right now, broken down step by step in the book. Links below. Go read it before month 14 finds you first.